All right. Good morning, everybody. Happy Friday. This is Alex Straton, Morgan Stanley's U.S. Softlines Retail and Brands Analyst on the equity side. I brought together a couple of my colleagues here today to address the global minimum tax implications across retail, a topic that has come up for select businesses like Skechers, Kraft, in the last week or so as a headwind to 2025 earnings. So more specifically, I've got Todd Castagno on with me, Morgan Stanley's head of global valuation, accounting, and tax. In simple terms, I call him our in-house accounting expert. And then I also have Jenna Giannelli here, my counterpart who covers retail and consumer from a credit perspective. So thank you guys both for joining me today.
Thank you.
Thank you.
So as it relates to format, we got 30 minutes today to get the lowdown from Todd on what exactly this global minimum tax is, why it's impacting retailers' guidance now, and how to think about who could be affected as we move further into fourth quarter earnings season, which mine haven't really kicked off yet. So Jen and I will also share what we've learned from our coverage and in our analyses so far. As usual, we've also reserved time to answer your questions. So if you're joining us via the webcast, click the Ask a Question button to submit your questions. If you don't feel comfortable doing that, you can always email any of us directly. We'll field them that way too. Finally, just one housekeeping item before I begin. I do need to remind everyone that for important disclosures, please see the Morgan Stanley Research Disclosure website at www.morganstanley.com/researchdisclosures. So with all that said, we can begin the discussion. Todd, I want to start with just the basics here on this tax reform. What is the global minimum tax regulation for dummies, book for dummies, and what was the impetus for its implementation?
Yeah, so this is something that's been in the works for you could argue almost 10 years. It's not a particular regulation, but let me give you the genesis. So there's a group called the OECD. Basically, it's an economic think tank research policy group that most developed countries and underdeveloped countries work towards. It's almost like a Davos for economics and tax, if you think about it that way. And so they've put together a series. We were talking about Pillar 2, which is the minimum tax. So you might ask, well, what is Pillar 1? For your companies, let's not worry about that. It's really, that's like a digital service tax, so that's another conversation. But there's two components, the Pillar 1, the Pillar 2. The Pillar 2 effectively tries to enact a 15% minimum tax on all larger corporates globally. Let's step back a little bit from how we got there. It actually kind of goes, in my view, goes back to the Tax Cuts and Jobs Act of 2017. So worlds are colliding here a little bit. And part of that was to lower the rate from 35 to 21. What U.S. Congress did, the previous Trump administration, to get revenue raising, they introduced a minimum tax. Now that was primarily oriented around, let's be honest, pharma technology companies. And what that did was say, well, effectively it's very much more complicated. Effectively, you need to pay around 13%. And so you had a lot of large multinationals that were single digits. Now they're all basically paying 13%. So that was kind of the impetus, I think, of or at least a catalyst for other countries saying, well, if we're gonna raise the water, there's revenue there. So there's a little bit of politics and everything. There's revenue to be gained. Now, what I want to say is the difference between our minimum tax, we call it Global Intangible Low Tax Income, GILTI, bad acronym in my opinion, but here's a key difference I always wanted to set the stage, is our minimum tax is blended. So if I have profits in Bermuda and then profits in China and profits in low and high tax jurisdictions, when I calculate that 13%-ish, I blend those together. The Republicans at the time wanted to do it on a country by country level. So it takes away that blending. And if I have a lot of profits in Jersey or Bermuda or wherever, you're going to bring that up to 13, 15, whatever it is. And then you're still going to pay at 25% and France or whatnot. So that's a key difference, and that's why let's get to what this global minimum tax is. So I think the impetus, the catalyst, is what we implemented in 2017. That's a good blueprint. Let's take it a step further. And so the OECD doesn't write legislation, but effectively it's countries getting together and they put together a principal set of frameworks for how would you implement this and legislate this in your country. And so there's an agreement of 140 countries effectively that said, I agree with the framework, and then you started to have countries implement it. And now you're starting to see it take effect. So maybe we can dive in a little bit of how it works. There's two principal rules under Pillar 2. One is the income inclusion rule that you can adopt. So in my country, if you're not paying, so Ireland's a good example. They had a 10% rate. They're going to adopt the income inclusion rule, and you're going to get grossed up to 15%. There's exceptions. So it's not, don't take everything. With anything in tax, there's always wiggle rooms and exceptions. We can get into that, but that's the concept. Now, you might want to ask the question, well, what if other countries have not adopted or they don't want to adopt it? So maybe I'm Bermuda, or Ireland. They set up these tax structures on purpose to get economic development in their countries intentionally. And you could have a view of it as a tax haven or not, but put that aside. The second component, so it's the income tax inclusion, you just gross up to 15%. The other one is what we call the undertax payment rule. So this is a little bit of a mind bender, but this is, I think, why you're seeing what you're seeing this earnings season. Excuse me. The undertax payment rule, basically, let's say I'm a multinational, I'm doing business in Europe, US, Bermuda. So let's say that I have a lot of profits in Bermuda, which is a zero tax jurisdiction currently, but I'm also doing a lot of business in France. Well, what France can do is says, give me all your profits by jurisdiction on paper. And then they'll say, well, you're not paying 15% in Bermuda, so we're going to deny you deductions that you would normally get, cost of sales, labor, XYZ. And that effectively gets them a share of that 15%. That's so I think, so the income tax inclusion rule took effect last year, and we haven't talked about this. We didn't have this webcast last year. So I don't think that moved the needle a whole lot. I think what, I'll take this, there's two things I think the undertax payment rule will kick in this year. And this is why you're starting to see. And so you can think about it as you have countries that have adopted this that are effectively trying to get profits that should be taxed in low tax jurisdictions. Now, there's one more wrinkle. There's some countries that don't want to fully adopt, but they are allowed to kind of adopt a minimum tax light, I call it, that also kind of kicks in. So let's say you're XYZ, you don't want to adopt the whole suite, but you'll effectively put in just the minimum tax. And so you've had, like, I think South Korea, if I recall, a few other jurisdictions that might kick in this year. But I think the lion's share is this undertax payment rule kicks in 2025. And I'll stop here and we can have a conversation. I just want one other thing while you're seeing this in earnings now. So that's the tax side. The accounting side is you look at each quarter, and what a lot of folks don't realize, each quarter isn't what my tax was that quarter. What your quarterly income tax expense is effectively what a vision of what you think your full year tax expense is. So I think, Alex, just to preempt your question, what we see right now, there's a lot of uncertainty. So what we see right now is certain companies having a best guess for what they think their full year tax rate is. A lot of things move between now and the end of the year. And so the other last point I'll just add right now is you could see a lot of tax rate volatility, and you could have companies in Q2, Q3 even, I don't know, in Q4 that have to true up. And maybe, what I've heard is the compliance around this in estimation is very, very, very challenging because it's brand new. And so you could see a lot more volatility in the tax expense provision.
No, that's a great initial overview, Todd. And I think something that surprised me in the last, week as we were kind of diving into it is the fact that you were publishing on all this, 3-4 years ago at this point. And I think you went into sort of what's changed and why things are different now. And you gave us some good information too on like, this could be something that actually comes up in later quarters, even if it didn't initially, just given the difficulty of sizing it and understanding it. But so is this something that like could also be a 2026 event, or is it squarely 25? Or how do we think about that timing?
Honestly, I think it has a long tail, because the other thing is you have to realize that each country is a sovereign and they will enact a version of this that could be their own version. Australia is a little bit different. It's got nuances. They all agreed to the 15% minimum rate, but what if XYZ country wants to take it to 17? I think there's upward pressure. I think one of the biggest challenges is dispute resolution, and so you don't have double taxation. And how do two countries work together? You say, well, I'm going to deny you deductions here, but the company might say, well, I think I'm paying what I need to pay here. And so all that has like an upward lift to the tax rate, unfortunately. The other thing I would just add is the U.S. is not privy to this. So the old administration, I think, wanted to play nicely, to put it blunt. This administration is firmly against these taxes. In fact, just about a week and a half ago, there's a House resolution of how the U.S. will counteract. So and I don't want to get too like scope creepy here, but the intersection of tariffs and taxes, economically, they're really not. Our economists might differ with me, but I mean, economically, they're not much different. And so President Trump and this administration are about to have retaliatory effects. So there is a code, Section 891, if you want to go read it, it's a paragraph. Basically gives unilateral power for the president to view any other country's taxes as discriminatory and then to retaliate. So, I know we're skewed too far off, but I know this audience is very focused on tariffs, and these two worlds are colliding, in my view. So that's just something else to watch for. Because I think as this news comes out and companies are guiding to higher tax rates, that is going to raise the eyebrows of Congress and this administration, and there could be knock-on effects to that.
No, that's a good segue and good detail as it relates to how tariff and tax can kind of interplay with one another here. Now, taking maybe a little bit of a step back, just from an industry perspective, and I know you did some work on this, so I would just love for you to kind of rehash it, is just, are some sectors more exposed to this than others? Or maybe put differently, which industries are in better or worse shape as it relates to potentially being impacted by this, and what tells you that?
Yeah, so again, I think if you go back in time to the TCGA, you have some very large tech companies, you can all name them, that were paying single-digit tax rates, and that kind of caught them up. And so when I say our 13% rate, it's like a band. It could be 10, it could be 15. There's a lot of nuance there that we don't need to get into. So I think that was the impetus to tax those companies, and you've kind of seen the proof in the pudding that did raise their rates. So I think there's maybe I think the knee-jerk reaction is that this is going to hit companies with a lot of IP, a lot of tech companies, a lot of pharmaceutical companies. And I think our version of the minimum tax pretty much got most of those. And I also think those companies maybe have anticipated this a little bit ahead of time and maybe have acted a little bit quicker. So that's why you're not seeing a lot. You are seeing disclosures, and you probably have a rate a rate move for some of those companies. Traditionally, they would be the most exposed. So I call it the type 1, type 2 error. Type 1 is if you have a very low tax rate, you would expect it to go closer to 15% plus. What I think the type 2 is what we're seeing right now in the consumer space. So a lot of the brands, there's a lot of IP there, and there has been a lot of, I think, sophisticated tax planning of where you put those brands. I'll bring an example: is the Coca-Cola is potentially going to the Supreme Court over a tax where they had a lot of intellectual property in South America, they might have a $20 billion tax bill at the end of the day. So, if you think about it, the way that the legal profession works is you put together a tax optimization plan and you just cut and paste it with all the other companies. So I don't know. I think it might have been between big tech and consumers, maybe more brands and more IP in different places is why we're seeing it now. I think there's uncertainty on different tax regimes and how they would change. Singapore had a very favorable tax regime. I think there's a lot of brand IP there that has evolved over time. So it's probably a mix of all the above. But I do say that the one thing is, if you're looking at a company and you're saying, well, they have a 22% tax rate and they're not impacted, to me that's the knee-jerk reaction is go look at the lowest tax rates and they're going to be the most impacted. And a few of those will be. But I also think you have very large companies where the rate can move 2 or 3 percentage points. And you say, well, they have a normal tax rate, I don't know what's going on, right? The Coca-Cola, just because it's in the tax court, is a very good example of that.
Great. So I think, you hit on some things that you can look for, but maybe just to dive into that further, just as Jenna and I are thinking about Softlines retailers and brands and who could be most exposed, have 2025 guidance risk or even beyond, what type of framework would you recommend using? And I know we've talked about it, and if anyone saw our note that we put out last week or last night, we kind of went through an initial framework, but can you just walk through, Todd, how you think about that for the audience? And then just any ballpark kind of guess you have for approximate impact. I know you gave some bands in some previous answers.
So one of the things I look at, so first of all, the disclosure is lacking. Unfortunately, the FASB has new rules that'll take effect like 3 years from now. So that's not going to help us today. There's a couple of ratios that I like to look at. And there's obviously the tax rate. Let's throw that aside. What I like to look at is the profit differential, foreign, domestic, and the revenue differential. So there's 2 footnotes to go towards that are mandatory disclosures. So usually in the segments disclosure, you're going to get your revenue breakout by significant jurisdictions. And then the tax footnote, usually it's the top table, is what is my pre-tax profit, domestic versus foreign. Now, what would be more helpful, and actually Skechers is a good example, it's one of the very few companies that does this, they break out their profit before tax or EBIT by country, by significant country. And so there's a good example. We had that disclosure. Why it works is, yes, majority of the revenue is in U.S. developed countries, but a very large percentage of profit was in Ohio, Jersey. Right, so that's what you would want to look for. If you don't have that country level detail, what I like to look at is there disproportion between the revenues split and the domestic versus international profit split. That can at least give you kind of an indicator that maybe there's some shifting of profits, because I think what most investors would think is the revenue should match the profit. And if it doesn't match the profit, maybe you ask the question why.
That's great. And then in terms of kind of, I know you gave us some on the phone the other day, just ballpark guess. I mean, we know from Skechers, I think the rate was going from like 17 to a low 20s. So that's a pretty big differential. Do you have any ballpark guess of how bad this could be, or is that just impossible to tell?
So give me like a wide margin of error here. My best guess is for most companies, you're probably not going to get more than a 2 to 3% rate increase. Now, I think the risk is that more countries are needing revenue, and down the road, they're going to use this framework to ratchet that rate up further. And then the other risk that I described is this is all brand new, and you have a risk of double taxation, and arbitration doesn't seem to be very robust. And so you can have 2 countries fighting for the same dollars or whatever, euros. And so you could just see a gradual uptick. But I'd say today, most companies are probably going to tap out, my best guess, 2 to 3%, if not just status quo.
Perfect. And maybe one final one for you, Todd, before Jenna and I kind of share some just initial thoughts. As we think about like moving ahead, are there any major milestones or events or details that we haven't even discussed about this regulation that we should be aware of as we think about potential future impacts?
Yeah, again, I think it's kind of right at this point, it's a little bit more ambiguous. And so only about a third of those countries have actually enacted it. And so that's why I think this could be a ratcheting scenario over the next few years as more countries. I don't know what the US is going to do with their TCJA 2.0. I would look for that. There's some view that they're going to play carrot and stick approach. And you're already seeing that, but on the tax side, I know we're crossing waters with tariffs, but for instance, right now, tech companies, if you build in the US and sell abroad, you get a rebate. That actually takes your rate from 21 down to call it 13. So you could see, I think, an expansion of that for maybe even consumer brands, or maybe brands come here and they sell rights overseas. And so, you know, you could have an up and down. I do think this administration and tax policy, they're going to address this somehow. And I don't know if it's just going to be with a carrot or if it's with a stick. That would be a catalyst to look for. And so we're going to monitor that and happy to follow up on that. But I think that's a big catalyst. Other than that, I don't think there's anything near term.
Perfect. I think it's definitely something that we'll have to be aware of and probably tied up with some of these tariff headlines that's worth monitoring. So look, Todd, super helpful overview on your end. I did want to just quickly share what we've learned from Softlines Retail and Brands perspective on our end. And Todd covered some of this, but just to really hit it home, I just think that the things that you guys should hear and that we tried to make clear in the note last night is just high level, super limited disclosure makes sizing this potential impact and risk pretty difficult across our group. But regardless, we did give it a go last night directionally by looking at a few things. The first is what Todd described in detail, which is focusing on companies that have the biggest discrepancy between foreign revenue exposure and then the reported foreign pre-tax income. Basically, those that report foreign EBIT exposure less than their operational exposure could be doing that for tax advantage purposes and then hurt by this GMT regulation. There were two other things that we looked at after a conversation with a couple of corporates that we cover. And the second thing was just highlighting companies where the divergence between the domestic and foreign tax rate is most notable, as again, they could be enjoying some sort of foreign tax favorability and be impacted by this as well. And the last and the final piece, and Todd, again, hit on this, is just looking at the aggregate foreign and effective tax rates across our coverage to see where it's particularly low and thus has some potential risk that it could move higher as we move to this, 15% minimum across the world. And basically, if your effective tax rate falls below 15, you're possibly getting some sort of advantage that's likely to come off as that rate, moves higher globally, barring some other reason or tax advantage that you could be getting, which again is hard to have visibility into. So it's not perfect looking at these three things, but using those metrics, it would have flagged something like a Skechers, and we would have, at least been aware of it heading into the print last week. And just for those that aren't as close to that one, it flags this as a 30-cent headwind to EPS for the year, which is a high single-digit impact from a percentage perspective. So it was meaningful. So other than Skechers, which would have been nice to know, about a week ago, looking at those things I just outlined, those three pieces, it also points to Levi, PVH, Tapestry, and Victoria as potentially being in this gray area of maybe they could be more impacted. So that's kind of the work we did and what we learned. We'll be curious to hear as we move through, earnings season. We've already heard from Levi and Tapestry. They haven't called this out as a headwind. But to Todd's point, maybe this is something that comes along down the pipe. We'll see. And now what I want to do just quickly, just because we have Jenna here on the line, is Jenna, can you just share, some high level thoughts on this topic, implications for you? I know you cover a slightly different universe of companies. So just curious if you've if you've learned anything else or what you'd highlight on this topic.
Yeah, of course. I mean, I think it's encouraging that we've all come at this independently, and now sharing views. We're all coming out with relatively similar conclusions, so that is encouraging. I think it's great that we're having the conversation, broadening the awareness, and adding some perspective to the concerns I think that were sparked to investors by Skechers and Kraft, as you mentioned. I think the good news is that within our coverage universe across, we cover retail, consumer products, the impact thus far has been fairly minimal, but I think from our initial read and look, it should also likely stay that way. Of the companies that reported, or what we know from 24 and 25 disclosures, we have had some, report thus far. None have referenced this yet as an input to any change or a factor in their guidance for this year, or have, even really factored it into the conversation. I think in addition to what, Todd was saying, that this has a long runway and there's a slow to build phenomenon, and the estimations for the undertax payment rule weren't being included before. I think the reason for this too, in our universe, is that we really do skew more toward those with domestic operations, right? So that's just by virtue of our universe. And where there are those international exposures from a revenue and earnings perspective, they are less tied to some of these, lower tax country jurisdictions, whether it's somewhere in Eastern Europe and the Middle East, where you've got more of those sub 15% rates. So it doesn't mean that it won't come up at all. So just to kind of frame, and similar to you said, Alex, those potentially more exposed, it's those we came up with in our apparel and wholesale universe, similar to what Todd was saying on brands, where they do have more international, operations, revenue, earnings, exposures, and then to a lesser degree our consumer products group. But again, it's still the skew versus our apparel wholesale tends to be less. And then retail coverage, while it's the most vulnerable, I'd say, in our universe from a credit perspective, from this issue, it's probably the least vulnerable in terms of where their revenue and profits are generated, leaving them a little bit, more insulated. It's ironic, I'd say, because among them, some of those with the lowest effective cash tax rates, they're for other reasons, right? And I think, Alex, that you caught this in your note, but it's whether it's because of NOL benefits or other such benefits, but it's not because they're benefiting from low-cost jurisdictions. So I think the punchline, what we look for, disclosures are limited and modest, but we're looking for companies that are, very large, profitable, multinational, globally diverse, and have among the lowest rung of effective tax rates versus peers. And those are the ones that may be benefiting the most from some of these low-cost, jurisdictions. And again, in our space, that's a handful of the footwear and wholesale apparel names. But like Todd mentioned, the caveat that we're talking about is that, perhaps this is just a few percentage points on an aggregated basis over time, which for our coverage from a cash flow perspective is still quite manageable and won't be a huge impediment as we think about, free cash flow conversion for the majority of our universe. So, I'll stop there, more to come, but I think it's great we're having the conversation.
Yeah, and Todd, you were super comprehensive in this. There is one question, the question being, how do you get to that estimate, that 2-3% change in tax rate, or what takes you there, makes you think that's the right ballpark?
That's why I said give me a wide degree of error. It is primarily like anecdotal, and I think, as Jenna mentioned, there's a lot of companies that you would expect it to be impacted, and it might not. We don't have a good lens in. Just it's actually anecdotal talking with basically heads of tax companies that said this is what we think the max is, and so I'm kind of using that as my benchmark. I think you're kind of seeing it play out in the numbers. Skechers is a little bit maybe of an extreme, but if you are impacted, you're probably not going to go much above that now near term. Now going forward, I don't, again, it's going to creep up. I mean, the last thing I would also add is, again, going back to the TCJA 2.0, again, we have that minimum tax, and that minimum tax is current law is scheduled to increase. And so, again, when I think about tax reform, the individual side of the code always takes preference over the corporate. And when you need money, that's where you go. So you could see, potentially the U.S. saying, well, if they're going to take 15%, I'd like to take 15% too. I think this administration doesn't like the politics of the way that it's been implemented.
Yeah, great, Todd, and appreciate that. I think understanding that Sketcher it's really one of the only anecdotes we have in the space right now. But to your point, it seems like it's more on the extreme end is probably what people need to hear in terms of where this could actually go for others if it does end up impacting anyone. So look, I know we're up on time. I'll end the session here. I know there's a couple other questions that we couldn't get to, but just feel free to email us directly or we'll follow up after this. Thanks again, everybody. Thank you, Todd. Thank you, Jenna, for sharing your thoughts on this. And thanks to the audience for joining. Have a great Friday and weekend.
Thanks, everyone.
Thanks, Alex.